I think we're in the era of payroll where people rent their time for money. And I think the future is an era of ownership. You know, one of my favorite phrases is the future is here. It's just not evenly distributed. And you see it in tech, you see it in public companies, but you don't see it everywhere. It's still an anomaly versus an expectation.
That's Henry Ward, CEO and co-founder of Carta. He's my guest today. Welcome to Invested at Work, a show about unlocking the power of workplace financial benefits for companies and their employees. I'm Rodney Bolden, Head of Industry Engagement and Learning for Morgan Stanley at Work, and your host. So what makes you invested at work? What does it take to lead a company as a founder and keep your team invested along the way? On today's episode, we explore the evolving role of founders in private companies, why some are choosing to stay private longer, and how they're offering liquidity to retain and motivate top talent. Plus, we discuss key insights from the journey to IPO and what it takes to get there. Henry, thank you for joining me on today's episode of Invested at Work.
Thanks for having me, Rodney. I'm super excited to be here.
Henry, for those in our audience who are listening or viewing, can you tell us, what does Carta do?
Yeah. We are, in one sentence, an ERP for private capital. And in three sentences, we manage the investors of companies, the investors of the funds that invest in those companies, and everything that goes along to manage that chain of how does capital flow from the people that have it into the companies that need it.
Tell me about, what was your inspiration for starting Carta?
I had started a previous company. This was 2011 Mountain View, where it was hacker culture, right?
Yes.
Everybody was starting a company. Everybody was doing a new app. So I decided to start a company. It was like a robo-advisor was my idea back then. But I did a terrible job. It didn't work, and the company died. But after that, I just fell in love with the idea of being a founder. I just wanted to be a founder. Didn't really care what I worked on, and I just needed a problem. The problem was a vehicle for which I could be a founder.
What was it about being a founder that really sealed it for you, that this was your path?
I loved everything that goes along with building your own company, which is you only eat what you kill. There's no A for effort. The market is completely objective. Everything you do matters. There's no one to blame but yourself. And just that there's, I think in the world today, for good reasons, it's very hard to live on the edge of something where success can be huge and failure can be awful. Most things are pretty well insulated. I think entrepreneurship and maybe professional sports are kind of two areas on the edges of society where everything you do makes a difference.
I like that comparison, because when you're out on the field, you're on your own. You may have a team around you, but you're on your own. And similar with being an entrepreneur. Now, as you started to scale the company, what were some of those learnings from that process of growing Carta? What were some of the key milestones, key decisions along the way?
There's so many. It's so hard. Often people ask, like, would you do it again? And I remember hearing the CEO of NVIDIA, when they asked him the same question, would you do it again? And he's like, no. As successful as he is, he would never do it again. And I feel the same, partly because it's hard, but partly because to do something successful in entrepreneurship, there's so much luck involved. We like to attribute it to skill. But skill without luck doesn't work in our line of work, in our business. You have to get lucky. You do make your own luck, but you do have to be lucky. I think what's interesting about the founder journey and luck is that because there's so much luck involved, people think anybody can do it. And it's sort of ironic. It's actually the opposite. So, for example, people pretty quickly decide they're not going to be a 100-meter, Olympic medalist, right? You pretty quickly can figure out, because there's not a lot of luck outside of like not getting injured and things like that. You can pretty quickly tell. There's not, if you have 10 people race 10 times, the same person wins most of the time. And in entrepreneurship and things like what we do, there's so much variability, which actually makes it harder, because you have to be good and lucky. In track, you just have to be good and not get injured.
Right.
In our line of work, you have to be good and lucky. But a lot of people mistake the luck for you don't have to be that good. You just have to be lucky. And I think one of the things that I look back on and what are the critical things along this journey is where did I create moments of luck? When I did get lucky, we could capitalize on it. And then when did I survive long enough to get lucky? One of my favorite lines from a post that I read when I was a young founder, early stage founder, was startups are pretty binary. You either go to zero, you don't make it, which is most outcomes, or you be big. But there's not much in between. So one way of looking at building a company is how do you be big? The other way of looking at it is how do you survive long enough to be big? And that's always been my view is just how do I survive long enough to get bigger?
Gotcha. I've heard you mention the term founder mode. Can you explain for our listeners and viewers, what do you consider to be founder mode?
Founder mode is this term that started going around Silicon Valley maybe 6 months or 12 months ago. And it was really set around this idea that, founders managing a company is different than professional management managing a company. And that it meant going deep into every business and being a control person and knowing every detail and telling everybody what to do at the lowest level, not respecting the chain of command of your organization. And it's kind of funny for me because this has gotten a lot of press, this founder mode concept, but it's like for somebody in it, it's like kind of obvious. Like I don't know that there's another way to manage the company.
Right.
The other side of it is, professional management also does a good job. I mean, there's a lot of companies managed well with professional management. Right. And I think it depends a lot on what kind of company you're trying to build. So if you're trying to build a company that steadily grows over time and has low volatility and high stability, you kind of want professional management because they play within the rules. They sort of manage the business within the constraints of the business. And if you want nonlinear outcomes, you want a founder that doesn't really see the rules and doesn't play inside the rules of how you conventionally manage a company. And that's where you see it. You see, kind of normal growth companies, I think the best examples is private equity companies. They have professional management. Right. They're managing a stable, low volatility, business versus founders are high risk. A lot of founders don't make it, but high reward because you find the one that can color outside the lines. They can create discontinuous outcomes. It's for example, it's hard to see a professional manager saying, you know what, forget taxi cab rules. Let's just go, get people to give other people rides in cars. Like taxi cab rules don't matter, right? Or hoteling rules don't matter, right? A professional manager wouldn't do that, but a founder might.
Right. Yeah, and it takes founders to take the industry to the next level in a lot of ways because there is that risk that's all in, and you don't see that when you don't necessarily see that when it's professionally managed, I would imagine.
Yeah, and I think another way of thinking about it is where do ideas come from? Do they come from the group or do they come from an individual? And arguably the worst ideas come from an individual, as we see in history in many cases, but also the best. Decisions that are made by a group tend not to be amazing. They also tend not to be terrible. They tend to be the status quo. And so another way to think about it is how do you want to build a company? Do you want to build a company that you're willing to take the risk of terrible ideas to get to good ones? Or do you want a company that you don't want to take that risk? And if you don't want to take that risk, you have professional management that has an exec team and a large board and all those things. And if you want one that takes risks, you rely on one person to decide which risks to take.
Now, as a company evolves from, startup, we have 3 people, all the way up to late stage pre-IPO. As part of that evolution, does the founder need to evolve their thinking as well in how they act and behave?
100%. I would describe the founder job or journey from early to late, and probably even after late in public, is you're never good at your job because as soon as you get good at something, you hire somebody else to do it for you. And then you move on to the next thing. So if you're an early stage, product founder, you build the product, you get good at building the product, and then you hire a VP of product to keep building, and then you go sell it. And then you figure out how to sell it, and then you get good at selling it, and then you hire a VP of sales to sell it for you. And so every step is doing the next thing. And by definition, you're never good at it. And I think one of the acceptance criteria for being a founder that can really go the distance is to not just accept, but embrace. You're just never going to be good at your job. And it's almost a problem when you are, because that means you're doing the thing you're good at versus doing the thing the company needs, which if you're really pushing the envelope for the company, it's always something new. If you're just doing the same thing over and over again, that you've gotten so good at it, that means you're not innovating. You're not pushing the company further. And so for me, it's been I'm never good at my job, but how do I get good at the certain thing I'm doing today so that I can train somebody else to do it and then move on to the next thing?
Do you find founders struggling with that concept? I'm never gonna be good at this particular thing, but just good for today. Have you seen examples of that?
Yeah, for sure. And I think the challenge for many founders on this is not even the acceptance, but the self-awareness of it. And so, am I not good at what I'm doing, but I'm getting better? And so I keep at it until I'm good at it. Or am I just not good at this? And there are cases of this, I'm not good at this, but I don't need to be good at this. This is something I should be able to outsource. There's many things I am not good at and probably never will be good at. And I'm very lucky that I have been able to assemble a team that is good at the things that I'm not good at, so I can focus on the things that are most important, or what I think are most important for me to work on. But I think many founders reflect and say, I'm not good at it, and so they have a crisis of confidence, which is a problem.
Right.
The other side of it is they get stuck in the I'm good at it mentality, and they have a crisis of self-awareness where they just don't understand why they're really good at something, but the business isn't doing what it's supposed to be doing.
Yeah. Let's talk about trends. So what trends are you seeing that are most impacting the current landscape from startup to late stage?
Yeah. I think the first obvious one that's won't surprise anybody is obviously AI is the new, crypto, which crypto was the new photo sharing, and we're going through that phase for sure. I think the other thing that's really interesting is we're at the early stages of this new trend with AI, and the amount of equity value or market cap or value creation that can be done from an early stage company today is remarkable. You're just seeing incredible scale of companies in terms of value creation with small numbers of people. What happens though in all of these is that's the early signs of a new market, but it doesn't scale. And there's an economic theory for this, which is this idea that the more a resource actually becomes available, the more expensive it actually becomes, which kind of contradicts the supply, laws of supply.
I was going to say that sounds contradictory.
Totally. And you see this in minerals where, nickel, was hard to get. So it was kind of expensive, and then it proliferated, and now it's in every semiconductor, and all these, companies need it. And so by creating more supply, you unlocked more demand. And it's a super common phenomenon in software, I would say, more than even commodities, which is, and the classic example is 12 years ago, everyone was saying the cost of starting a company has gone down because of the cloud and open source software. Instead, actually what happened is because the cost of creating software went down, the quality and competitiveness of software had to go up. And so there were so many software companies being started that we've raised way more money to do a software company in the last decade than they did the decade before, when theoretically the cost of doing a startup should have gone down.
Right.
And that's going to happen, I think, in AI, and it's just happened in every category. So there's a proliferation of AI startups, but it will be much more expensive to be that breakout company.
Now, companies are staying private longer. And if I'm coming to work for a private company, I'm coming probably because I'm passionate about what they do, but also I'm looking for that liquidity event down the line. As companies stay private longer, what are some ways that companies can look to provide some liquidity solutions to their employees?
The dominant form of liquidity for private companies today is the tender offer. And how the tender offer works is in the private markets is usually it's in conjunction with a primary financing. So let's say the company decides they're going to raise $100 million of a Series D private capital, but they have $150 million of demand. So $150 million worth of investors wanting to invest, but they only want to raise $100 million for the business. What they'll often do is they'll take that $50 million and then allow employees, early investors to sell into that $50 million. That's the most dominant form of liquidity. That's what all the best companies do. I think that will continue to be the dominant form.
What are some of the challenges when offering that liquidity solution to employees? And more importantly, not just the challenges, Henry, how do companies overcome them?
Yeah, the biggest challenge is the moment of doing it is not the challenge. Everybody loves it. The employees are happy. Investors are happy. The CEO is a winner across the board, right? Because the company got its money. New investors got their equity, and employees and early investors got their money. So everybody wins. It's the challenge a lot of companies had is they did this pretty regularly in the circa 2018 to 22. And then they stopped for a couple of years because it only works when you have excess liquidity. By definition, it's the way that you soak up excess demand by allowing people to sell. And when liquidity dries up, there's no available tender offers. So the biggest challenge is how do you explain or what do you say when there's a long period where there isn't a lot of liquidity, which is what we saw in 22, 23, and 24. And I think that's what most CEOs are wrestling with. I think now it's starting to come back and CEOs are in a better spot. But the biggest challenge is actually not when you do it, it's when you don't do it.
Any strategies for that challenge that you see companies employing when it dries up?
Yeah, I think for a lot of CEOs, it's education. It's just explaining the market cycle, the dynamic. I do think for many CEOs where the CEO can't explain the growth story and a future liquidity event, they will really struggle. Because if you're an employee and you don't see the company growing and you don't see liquidity, which unfortunately tend to go hand in hand as well. If you're not growing, it's harder to get liquidity. CEOs are having a hard time keeping those companies together.
Right. I often hear the term the path to IPO. And when I think of path, I think driving. So when you're driving, you reach certain milestones, mile markers, but you also may come up roadblocks, construction's going on, or you have to take a detour. What are some of the common milestones and roadblocks that you've seen on that path to an IPO?
The interesting thing about going public is, and I spent a lot of time in DC talking about, how to make more public companies. And there is a false narrative, I think, about going public, which is what keeps companies from doing it is the compliance and regulation around it. So, it's just too much, regulation. And I don't think that's true. I think the reason why companies, including us, worry about going public is it is increasingly competitive, and it is increasingly punishing companies that aren't ready. The competition is so high in the public markets that it's very hard to enter the public markets and just even get analysts to cover you, let alone people to say, of all, the amazing companies in the public markets, I'm going to pick yours. And the bar for the financials, the vision, the product set, the customer base is just so high that most companies are like, wow, I really need to hit this hurdle before I go public. The regulatory stuff is not the issue, right? Even if it costs $1 million a year to manage Sarbanes-Oxley and compliance, that's for a business that's doing $1 billion in revenue or $500 million. That doesn't matter. It's am I ready to compete in this public market venue where everybody can see every day what we're doing?
What are some of the key learnings on that path that if we have CEOs, founders listening, what would you say to them that, hey, these are some things I've learned along the way working with founders that I think can help you as you navigate that path to IPO?
One of the things I've learned going from early stage to pre-IPO over the last 11 years is there's all this kind of personal growth stuff that I could talk about forever. But the other thing is there is a difference between a early stage vision-oriented founder and a CEO that's going to take a company public. There's just a different way to think about the business. And I learned this the hard way because I have a lot of venture investors on my board, and I also have some private equity investors. And they just think about the world differently. And the venture investors are, where I came from, all vision. We're going to change everything. It's all about the upside. It doesn't matter how we run the business as long as we realize the vision. Growth solves everything. And then you get the PE guys that come in and talk about things like gross margin and EBITDA and cash flow and the best, I think, CEOs are able to keep the vision, but then start to instill the rigor and discipline and structure around how to scalably build a business over time. And that's something I've been learning over the last few years is how do I take a nugget of incredible vision and an incredible team, but then put the discipline and rigor around it so that people on the outside understand how we do this sustainably over a decade.
Speaking of vision, many employees out there, whether they work for public companies or private companies, according to a survey done about a year ago by Gallup, 6 out of 10 employees today, American adults today, say that they want to be an entrepreneur. Have you seen instances where working either with Carta or with other companies that some of your employees have then gone on to do other things and find and start their own companies, and how do you support them?
Unfortunately, yes. I've seen lots of Carta employees go start their own companies, and it drives me crazy. The biggest competition for talent for Carta is not other employers. It's starting your own company.
Oh, wow.
We have a ton of current founders that were former Cartans. And most of them, if not all, I invest in as an angel investor. And I famously wrote 10 years ago when we started the company our manifesto, and I said the greatest thing that Carta would produce, and this is a memo to employees, the greatest thing Carta would produce is not software or even a company, it's you. The next generation of great entrepreneurs and founders I hope will come out of Carta. And that's really a testament to the thing that we created. Unfortunately, that's been more true than I hoped sooner than I expected. But it's fantastic. What's actually really nice about it is, nobody secretly starts a company. They call me and they're like, "Hey, I think I'm going to leave and start a company in 3 months." And I actually help them, offboard and get started, and they become, we become the first customer for many of them. I bring them back after a year, and they pitch to the company, and we get them going. And it's a way that I wrote a post called Founders Wanted, which is I love hiring both former founders and future founders because there's just something about that mentality. The cost is I lose them, which drives me crazy, but the benefit is I get that DNA into the organization, which I just love, and I think has been one of the keys to our success.
I was going to ask you about that because I would imagine that by putting it out there, hey, we're supporting your founder dreams here, you come work for us, you probably attract talent that is very entrepreneurial, that helps the business before they leave.
100%.
Is that the case?
Yeah, 100%. And a lot of our new products were created by people that were, entrepreneurs, but inside Carta, and they wanted to build something new. And many of the new products we built were ideas of Cartans, not mine, that wanted to build something. We gave them the leeway and the resources to do it. They built it, and then later they said, "Hey, I'm going to go do it on my own now, a different product. But you showed me how to do it inside a company. I want to do it outside a company." The challenge, like anything, is the blessing and the curse. Is you get all this innovation. It's also incredibly difficult to manage because there's the managing a founder by definition is not easy. And I can do it reasonably well because I know the type. But you also have lifers, right? People at Carta that love Carta, will build Carta forever, and don't want to be an entrepreneur. And it's like oil and water, right? Because they're like, we have to build the company. It's all about the company, and we have to work within the rules and all of these things and structure and scale. And then you got this, founder at the company that's like, I don't care about the rules. I just want to do it the way I want. And there's this clash. And we talk a lot about it. We call it sometimes we also call it missionary versus mercenary, right? People that are there just for a vision, and others that are like, no, we're building a business for financial gain. And these two groups hate each other, and they and they're in the same room. They're in the same exec team, right? Yeah. And managing that's always the challenge.
I bet. Any advice for other founders who are in that similar situation?
To get a business to scale, you need a combination, which is always not the most frustrating response. But there is something like, I don't know what the exact rule is, but call 1 in 10, right? You need, for every 9 mercenaries that just wants a job, you need 1 missionary that's just, ride or die. And you keep those people closer to you. Because they're the ones that's the nucleus of the company. And it's not a question of rank, of title. You can have missionaries that are on the support, on a support team, and you can have them in the exec team, and you could also have mercenaries on the support team and the exec team. But having the right combination of those, and then figuring out how to manage that, I think that's the art of scaling.
Gotcha. Where do you see the future of equity and liquidity going?
I think there's 2 vectors that I find very compelling. So one is, I've often said, I think we're in the era of payroll where people rent their time for money. And I think the future is an era of ownership where people will get a share of the upside of their company for their work. And you already see it. One of my favorite phrases is the future's here. It's just not evenly distributed. And you see it in tech, you see it in public companies, but you don't see it everywhere. It's still an anomaly versus an expectation. I think the other macro vector is another way to think about the mission at Carta is we're trying to make private markets look more like public. Public markets are transparent. There's pricing. It's real time. Everybody can see the same stuff. We want to make private markets operate more efficiently and more transparently like public. And I think, when I talk to regulators about the lack of IPOs problem, my framing is there's 2 ways to solve it. One is to get more companies to go public. The other is to bring more rigor and transparency around the private.
I want to ask you, what are 1 or 2 things for the founders listening and watching that you want to leave them with from our conversation today?
I think one of the things I think a lot about in terms of the founder journey is it really is a change of who you are as a person, and in a shocking way, not always for the better. It makes you change. The way you think about the world changes. And I'll give you an example. One of the founder, I think, skills is to see things that are obvious to you but not obvious to others. And that is both a wonderful thing and also a curse, right? Because you're like looking at the world and go, why does the world work this way? And then your job is to convince everybody, and they think you're crazy, and they don't. And the thing is you're not always right. We read about history is biased to the people that are successful. So like they knew it all along. I promise you, every good idea I had, I did not know it. And this curse of feeling like, man, why does the world work this way? It's so bizarre. I want to go change it, but everybody thinks you're a fool for doing it. It is a curse. Like if you're right, it works out great. If you're wrong, you look like a fool in history, and that's the trade. And I don't know a lot of founders. I don't think that way. It's a lifestyle change. Even it's funny talking to my son. He just thinks I'm weird, and he's not wrong. And it's just it's a different way to live.
One final question for you, Henry. What makes you invested at work? What gets you going to go into the offices of Carta every single day and say, this is what I want to do?
I did this survey pretty frequently at Carta, and it really only had 3 questions. It was, why did you come to Carta? Why do you stay? And what do you want me to know that you don't think I already do? And 90% of the answer of why people came to Carta was the vision. But something shifted, because when you ask them why they stay, it's not the vision. They stay for the people. And I think the same is true of me. I originally started this, because I wanted the founder journey, and I still enjoy it. But after 10 years, 2,000 current employees, thousands of former employees, shareholders, customers, most importantly, just everybody that relies on Carta. It's just to fulfill all the things that I committed to. Somebody once told me, they said, your job as a founder is to make everybody who believed in you look like a genius. And a lot of people believed in me and Carta. And so, I wake up every day excited to try to make them look like they were geniuses.
Excellent. Henry, thank you so much for joining me today. It has been truly enlightening.
Thank you, Rodney. So appreciate being here.
Thanks.
Thank you.
If you're interested in more conversations about workplace financial benefits, subscribe to the show wherever you like listening to or watching podcasts. If you hear something you like, please share it with colleagues and friends. And if you want to learn more about what Morgan Stanley at Work can offer, visit us at morganstanley.com/atwork. Invested at Work is brought to you by Morgan Stanley at Work, hosted by me, Rodney Bolden. Our executive producers are Fiona Kelsey and Lisa Boyce. Our production partner is Sequel Media Incorporated.